Hello Kopitiam friends and fellow dividend hunters. If you've been wondering whether Mapletree Industrial Trust, or MIT, is still one of Singapore's most reliable REITs for steady Kopi money income, then stay with me till the very end of this video, because I'll walk you through MIT's latest 2025 results, its 6% dividend yield, and how the recent Fed rate cuts could be a real game changer for its future outlook. And hey, if you find this breakdown useful, don't forget to give this video a thumbs up so that more Singaporeans can discover these insights. And subscribe to Wealth for You for more deep dives on CPF, REITs, and dividend investing made simple. Everything I'll share today, including all the financial numbers, is extracted directly from Mapletree Industrial Trust's official disclosures on the SGX website, dated 29th of October 2025. We'll go through what a REIT is and how it helps you build passive income, MIT's property portfolio, what it owns, where, and how it's performing, MIT's latest financials for the quarter and half year, its valuation, dividend yield, and cash flow strength, and how the Fed's rate cuts could impact MIT in 2026. So grab your Kopi, sit back, and let's dive in. This video is for educational and informational purposes only. It is not financial advice. This content does not consider your specific investment objectives, financial situation, or needs. Please do your own due diligence and consult a licensed financial advisor before making any investment decision. Past performance is not indicative of future results. Chapter 1. What is a REIT and why income investors love them? A REIT, or Real Estate Investment Trust, is a listed vehicle that owns and manages income-producing properties. It collects rent, pays expenses, and distributes at least 90% of its taxable income back to unit holders. For Singapore income investors, REITs are popular because they offer regular, predictable cash flow, liquidity on the SGX, and exposure to real estate without needing to buy an entire property yourself. Think of REITs as your own little property portfolio, one that helps you become cash flow rich, not just paper rich. Every quarter, your dividends come in, paying for your Kopi, your char siu rice, or even a weekend getaway. That's the power of compounding income. Chapter 2. Overview of Mapletree Industrial Trust. MIT, short for Mapletree Industrial Trust, is one of Singapore's most established and well-diversified industrial and data center REITs, proudly listed on the SGX under the ticker ME8U. It isn't just another industrial landlord. Over the years, MIT has evolved into a modern global platform that owns 136 properties across Singapore, North America, and Japan, managing a total asset under management, or AUM, of about 8.5 billion Singapore dollars. Here's how that portfolio is spread out. Singapore, 79 properties, approximately 47% of AUM, the stable heart of the portfolio. North America, 55 properties, also about 47% of AUM, mostly high-spec data centers serving cloud and AI tenants. Japan, 2 properties, roughly 6% of AUM, including the newly completed Osaka data center. MIT's asset mix ranges from high-tech buildings and business parks to flatted factories and data centers. These days, data centers contribute close to 60% of its AUM, making them the single biggest growth driver within the trust. This steady shift toward digital infrastructure assets has transformed MIT from a traditional industrial REIT into a hybrid income and growth vehicle, one that delivers dependable rental income from Singapore's industrial backbone, while capturing long-term upside from the surging global demand for cloud and AI data facilities. In short, MIT offers Singapore investors the best of both worlds: stability from home and growth from abroad. Chapter 3. Portfolio Performance, as of 30th of September 2025. Despite the softer economic climate, MIT's property portfolio has stayed resilient. Across the board, the REIT maintained a healthy occupancy of 91.3%, just a hair below the previous quarter's 91.4%, a sign that tenant demand remains steady even after the sale of several Singapore assets. In Singapore, MIT achieved an impressive rental reversion of plus 6.2%, meaning most tenants renewed their leases at higher rents. Average rentals on the island rose to about $2.27 per square foot per month, reflecting continued strength in Singapore's industrial and high-tech property segment. Meanwhile, the portfolio's weighted average lease expiry, or WALE, lengthened slightly to 4.6 years, helped by new 5-year lease renewals in North America, a positive sign of long-term tenant commitment within its data center portfolio. On the strategic front, MIT also completed the divestment of 3 Singapore properties, the Strategy, the Synergy, and Woodland Central, for 535.3 million Singapore dollars in August 2025. This move wasn't just about selling buildings, it was about strengthening the balance sheet. The proceeds were channeled toward lowering debt and improving financial flexibility, giving MIT more firepower to reinvest in higher-yielding, next-generation assets such as data centers in Asia and Europe. Overall, the story here is one of discipline and resilience, a portfolio that continues to deliver stable income while being refreshed for future growth. Chapter 4. Financial Performance for Q2, FY25-26, and 1H, FY25-26. Alright, let's dive into the numbers behind MIT's 2025 results, covering both the second quarter, from the 1st of July to the 30th of September, and the first half of its financial year, from the 1st of April to the 30th of September. During this period, MIT's performance reflected a period of transition. For the quarter, gross revenue came in at 170.2 million Singapore dollars, down about 6.2% year-on-year. The decline filtered down to the bottom line. Net property income, or NPI, slipped 7.8% to 124 million Singapore dollars, and distributions to unit holders eased 5.3% to 90.7 million Singapore dollars. The result? A distribution per unit, or DPU, of 3.18 cents for the quarter, about 5.6% lower than a year ago. When we look at the half-year figures, the story is similar. MIT generated 346.1 million Singapore dollars in revenue, down 3%, and 257.7 million Singapore dollars in NPI, down 3.5%. Distributions over the half-year reached 184 million Singapore dollars, leading to a DPU of 6.45 cents, which was about 5.1% lower year-on-year. Management attributed these softer results mainly to the absence of one-off divestment gains, the weaker US dollar, and the loss of rental income after selling 3 Singapore industrial properties earlier in the year. But there's a silver lining. MIT's financing costs actually improved. The REIT used part of its divestment proceeds to pay down loans, which helped reduce the average borrowing cost to just 3%. That prudent capital management cushioned the impact of lower revenue and positions MIT to benefit more quickly once interest rates start falling. In short, while 2025's results show a temporary dip in headline numbers, the underlying fundamentals remain steady, and the trust is quietly strengthening its financial base for the next phase of growth. Chapter 5. Is MIT undervalued or overpriced? Now, let's take a closer look at how the market is valuing MIT today. As of the 31st of October 2025, MIT closed at $2.13 per unit, giving it a market capitalization of roughly 6.2 billion Singapore dollars. That makes it one of the larger and more liquid names in Singapore's REIT space. Financially, it remains conservatively managed. MIT's gearing ratio stands at 37.3%, comfortably below the MAS ceiling of 50%, signaling a healthy balance sheet with room for future acquisitions. On the valuation side, the trust trades at a price-to-earnings ratio of around 17 to 18 times, which is fairly moderate for a REIT of this size and quality. Its price-to-book ratio sits at about 1.22 times, just slightly above its net asset value of $1.69 per unit, suggesting that investors are willing to pay a small premium for its stability and global data center exposure. Meanwhile, the return on equity hovers between 6 and 7%, consistent with what you'd expect from a mature, income-focused REIT. Putting it all together, MIT looks fairly valued. It's not a bargain bin play, but it's also not overpriced. At current levels, investors are getting a 6% dividend yield, supported by high-quality assets and a management team with a strong track record. In other words, MIT sits in that sweet spot, a steady, dependable REIT offering both resilience and income stability in a volatile global market. Chapter 6. Dividend Yield and Sustainability. Now let's talk about what really matters to most income investors, the dividends. At the current unit price of $2.13, MIT is delivering a trailing yield of about 6%, based on an annualized DPU of 12.72 cents. Looking ahead, analysts estimate a forward yield in the range of 6.3 to 6.6%, which keeps MIT firmly in the league of reliable income-generating REITs. For the latest quarter, unit holders can look forward to a distribution per unit of 3.18 cents, with an ex-dividend date on 5th November 2025 and a dividend payment date on 10th December 2025. So if you hold MIT units before 5th November, you'll be entitled to this payout. A nice little Kopi money top-up before the year ends. The big question is, are these distributions sustainable? The good news is that MIT's operating cash flow comfortably covers its distributions, leaving a healthy buffer for short-term volatility. Its gearing of 37.3% gives the trust plenty of financial flexibility, and the interest coverage ratio sits around 3.9 times, which is still a solid safety margin. However, it's not all smooth sailing. Revenue and NPI fell about 6 to 8% year-on-year, mainly due to the sale of several properties and weaker USD income from its North American assets. That means future DPU growth may not come quickly, at least not until interest rates fall further or new investments start to contribute. Overall, MIT's dividend remains sustainable in the near term, supported by prudent management, a sound balance sheet, and resilient cash flow. But investors should keep expectations realistic. The REIT is in a consolidation phase, focusing on maintaining stability today while positioning for gradual income recovery tomorrow. Chapter 7. Future Outlook. Now let's look ahead, because this is where things get interesting for MIT and the broader REIT market. In October 2025, the U.S. Federal Reserve cut interest rates by 0.25%, bringing the target range down to 3.75 to 4%. The Fed made this move to cushion the economy against slower growth and a cooling job market. For MIT, this is largely good news. Lower global interest rates translate into cheaper refinancing costs, which means higher distributable income over time as existing debt gets refinanced at lower rates. On top of that, declining rates often lead to cap rate compression. In plain English, property valuations rise because investors are willing to pay more for stable income streams. That, in turn, can lift MIT's net asset value per unit. Lower rates also tend to draw investors back to yield assets like REITs, especially when bank deposit rates start falling. So sentiment toward income-producing trusts like MIT could strengthen as 2026 unfolds. Of course, there are still headwinds. A weaker US dollar could reduce the value of MIT's overseas income when converted back to Singapore dollars, and a slower global economy might weigh on leasing momentum. But the trust is entering this new cycle from a position of strength. Its gearing is moderate, its balance sheet sound, and demand for its data center assets continues to rise, driven by cloud computing and AI growth. So in short, Fed cuts mean lower debt costs and stronger valuations. But the benefits will unfold gradually as existing interest rate hedges expire and refinancing cycles kick in. Chapter 8. What income investors should watch out for. The story doesn't end here for Singapore income investors. The key is to keep watching the right signals, the ones that tell you if MIT can maintain that reliable 6% COPI money yield. First, keep an eye on occupancy levels. As long as portfolio occupancy stays above 90%, income should remain stable. Next, monitor rental reversions. Positive renewals, meaning tenants paying higher rents upon lease expiry, show that demand for MIT's properties remains healthy. Also, watch debt maturities and hedge expiries, especially through financial years 2026 to 2027, as these will determine how quickly lower interest rates can translate into savings. Keep tabs on the USD to SGD exchange rate, because excessive weakening of the US dollar could chip away at overseas contributions. Then, track how fast MIT redeploys the proceeds from its recent property divestments into new income-accretive assets, ideally data centers or high-spec facilities. And finally, make sure dividend coverage remains tight. The distributable cash flow should continue to comfortably support its DPU. If these key factors stay in check, MIT will likely continue to deliver a steady 6% yield, appealing both to retirees looking for consistent income and to long-term investors building their dividend portfolios one COPI at a time. Final thoughts. As we wrap up, here's the big picture. Mapletree Industrial Trust's 2025 results tell a story of quiet strength and resilience. Despite headwinds from currency swings and softer leasing momentum, MIT continues to deliver, backed by a solid balance sheet, disciplined management, and a portfolio that's both diversified and future-ready. Its gearing is healthy, its dividend yield remains attractive, and its assets, especially data centers, are positioned right where global demand is growing fastest. With the Fed now cutting rates, financing pressure will begin to ease, opening the door for a gradual rebound in distributable income and valuations through 2026. It won't happen overnight, but the direction is turning positive again. For Singapore income investors, MIT remains what I call a steady REIT cornerstone. It may not make you rich overnight, but it helps you stay cash flow rich, paying you consistent COPI money quarter after quarter, year after year. So if you found this analysis useful, give this video a thumbs up. It really helps more Singaporeans discover long-term investing content. And subscribe to Wealth for You for more smart, simple dividend strategies that make your money work as hard as you do. Thanks for watching. And as always, may your dividends flow as steadily as your morning COPI.